Hello and welcome back to the channel. Today we are discussing a practical example of a business combination accounting that you can use either for your ACCA studies or if you are preparing consolidated financial statements in your job. This is in response to a comment that we received requesting for such discussions on the different journal entries required for a company undergoing a business combination. So for your reference, we will not be discussing in detail here so much of the theories about IFRS 3, except if they refer to the practical example that we will be discussing. So if you are new here, don't forget to subscribe so you don't miss out on any topics that we post about consolidation in this channel. We will be discussing a single problem for your reference. The single problem will have goodwill, a discussion on step acquisition, meaning that the company that is being acquired already has the company acquiring the acquiree already has a previously held interest on the company. We have PPA fair value adjustments, non-controlling interests that are measured at fair value at the time of acquisition, and a multi-year consolidation of the same two entities, because it is important for you to follow what happens at the time of acquisition and also in all the subsequent years of the consolidation. So we will be posting the problem into the description of the video below this video so that you can copy paste them easily if you are following the discussion on your own. So what is the background? On April 1 year X, the first year, Alpha Corp, the parent, acquired an additional 50% ownership interest in Beta Limited, which is the acquirer, increasing its total ownership from 30% to 80%. So this is what we mean by a step acquisition, thereby obtaining control over Beta Limited. The consideration paid for this 50% acquisition was 5 million, and it is paid in cash. Prior to the acquisition, Alpha Corp held 30% interest in Beta Limited, which was accounted for using the equity method. On April 1, the fair value of Beta Limited's equity was determined to be 9.5 million. A fair value assessment as at April 1 of Beta Limited's net assets identified the following differences. So the PPE, the property, plant, and equipment, had a fair value that was 600,000 higher than its book value, and the remaining life of the PPE is 5 years. And there are customer intangibles that were identified with a fair value of 1.2 million, not previously recognized in the books of Beta. So for simplicity, the customer intangibles are expected to be useful for an additional 5 years. The non-controlling interests in Beta Limited is to be measured at fair value at the time of acquisition. So there's a lot of things to unpack in the problem. However, it is useful for you to also look at the balance sheets and the income statements provided at the time of acquisition. You will see here for Beta Limited, this is the balance sheet as at April 1, and you will see in the income statement as well that it is 0, meaning that we already closed them to the retained earnings. Since Beta is already an operating company, we expect them to have net income during the year. However, at the time of acquisition, everything restarts. You have to remember that. So all of the net income of Beta Limited up to the time that it was acquired should be close to the retained earnings account. That is a very important distinction. And also for Alpha Corporation, since they acquire the company as a parent, acquire Beta Limited as a parent, there's not going to be a restart. So they started their year January 1, and up to the time of acquisition of April 1, they already have a net income. So we're going to include that in the consolidation. So you will see also that the investment in Beta Limited, 30%, has 2.4 million already, which represents the equity accounted equity accounted value of Beta Limited in the books of Alpha Corporation as the investor. So those are the most important things for me to discuss for you here. You see here that there's a net income current year, which corresponds to the net income here down, which the breakdown is operating expenses and share in the net income of Beta, because up to the point of acquisition, Beta is accounted for using the equity method. So the equity method is a different discussion. We will deal about that later. So it's important for you to realize that there are different consolidation timeframes. What I would like to discuss with you right now is the acquisition date consolidation, and then later we will discuss the first year end. The acquisition date consolidation is important because it is the time when the acquiree enters the consolidation group. It is a time when control is established by the parent. So what happens here is that during the full year one is existing in the point of view of the parent. During the acquisition date, what happens is this is when the subsidiary enters the books of the parent and there become consolidated. However, from the time of the acquisition date to the first year, and that is only the time when the P&L, the profit and loss or the net income of the subsidiary of the new subsidiary will enter into the books of the console. Anytime before, for the subsidiary's point of view, is going to go into the pre-acquisition reserves or into the retained earnings. That's why here at the time of acquisition, you will see typically you shouldn't have any net income at the level of the subsidiary that is being acquired. So that is the very important thing to remember for the acquisition date. The acquisition date is when you do all the PPA fair value adjustments, all where you determine all of the values, the fair values at the time of acquisition. So it's very important to know how to do the business combination journal entries. So what happens during the acquisition date? So this is the same problem that we have. I just transposed it and smaller so that we can show you the computations. So the first thing that you need to do when you are faced with a business combination problem is to determine the purchase price allocation, or determine as a result of the purchase price allocation, you're able to determine the goodwill. And the purchase price allocation actually becomes the basis of the journal entries that you will be posting all throughout the years that you're consolidating these two companies. So what happens in a purchase price allocation? So the purchase price allocation is you're comparing two things. What is the total consideration of the transaction, meaning what is the value that went out of the business? And number two, the fair value of the identifiable assets and liabilities that came in. So the two things, what went out and what came in. So the fair value of the identifiable assets and liabilities are the values that we have acquired from Beta Limited, plus and minus any fair value adjustments that we have identified here. That's why this one is very important. This one is what value, what are the adjustments to the values of beta that you are taking inside as a parent, and the total consideration, or what are the values that went out, including the value of the non-controlling interest if you do not own the subsidiary 100% after you have gained control, because here we only have 80% ownership after the control is established, meaning there is a 20% NCI, or non-controlling interest. So let's discuss it step by step. So the goodwill computation, according to IFRS 3, there are three components. The fair value of the consideration transferred. It could be in cash or non-cash. Could also be a fair value of a liability that was assumed, liability or contingent liability. Number two, fair value of the previously held interest. So the previously held interest is the initial 30% that you have, because when you are acquiring a new subsidiary, you're especially on a step acquisition, you already have a value of the asset that you have in your books. In this case, you already have 2.4 million. So you need to put this at fair value. You cannot use the equity accounted value of 2.4 million. So here you see that it is 2.2850, because this is the fair value of the 30% investment in beta. So you will see it later how we have computed the 2850. But just so you know, the first component of consideration is the fair value of the consideration that you transferred in cash or in kind, fair value of the previously held interest, not the one in the books, but the fair value, and the fair value of the non-controlling interest. Or if you have adopted the other approach, you can use the proportionate share of net of NCI, but we will not use that. We will in the learning goals here, we are going to use the fair value of the non-controlling interest. So all of these three composes the total consideration. How did we compute the fair value of the previously held interest? So we have here in the problem saying that the fair value of the Beta Limited's equity, the shares of all of the shares of Beta, has a fair value of 9.5 million. So that 9.5 million, 30% of that is 2.850, meaning that instead of 2.4 million, we say that the value of the books of Alpha, it's 2.4 million. We have the fair value of this 2.4 million is 9,850,000 in actuality. So, and then the fair value of the NCI is also 20% of the 9.5 million. So, the next step that we need to do is to compare this total consideration, because this is the value that went out of the parent, to the fair value of the identifiable assets and liabilities in full. Even though you have NCI, since you have NCI here, you also have to put the NC sort of the 100% of the value of the net assets and liabilities, because sometimes you can get confused that, hey, we're only owning 80%, so we just put 80% of the fair value of the assets and liabilities. That is not correct, especially if you are measuring your NCI at fair value. So here, you're putting the fair value of your assets and liabilities that you have acquired at 100%. So here, so in the current balance sheet, you have a fair value of 7 million, which is all of your assets and liabilities. So your cash plus accounts receivable plus inventory plus PPE minus trade payables minus external debt. So that sums up to 7 million. So for simplicity, you can also add the share capital and the retained earnings, because this too is also the net assets of the company. So that is not complete, because according to the problem, the fair valuation that was performed for the business combination, they determined that the PPE should be valued 600,000 more. So we add it to the 7 million. So from here, we add 600,000. And there is an unrecognized customer intangible. And there is also an unrecognized customer intangible of 1.2 million, according to here. So it goes to show that the total fair value of the identifiable assets and liabilities that you have acquired as Alpha company, you have total consideration that went out of 9,750. You absorbed 8.8 million total of all of those fair value. You have an excess of 950 million. That 950 million is the excess that cannot be attributed to any identifiable assets and liabilities of the acquiring, which means that this is already the goodwill. So the goodwill happens if the consideration is higher than the fair value of the assets and liabilities acquired. Because just think about it, this is the fair value that of the assets and liabilities that you have gotten. It's just like you're purchasing an asset, and you have paid more. You paid 9.7 million, 9.8 million for a net asset worth 8.8 million. So there's an extra, there's an extra consideration that you have paid. So this is now what we're calling as the goodwill, because this is something that you are valuing in excess of the fair value already. That they tell you that the fair value is already 8.8 million, and you're saying, no, I want to pay 9.8 million. So now the 950 becomes the goodwill. Another way of looking at the purchase price allocation is also, you can also split it between the parent and then the goodwill and then the non-controlling interest, because here you see, it's just the same, these two. So what you can see, but we are splitting it between the NCI and then the owners of the parent. So you see that the first two belong to the parent, because these are literally the amount of value that went out from the parent, right? So and then it's the 8.8 million, 80% of that is 7.7040. And then the actual goodwill, out of the 950k goodwill, 810 belongs to the parent and 140k belongs to the non-controlling interest. So this is a very specific instance when the non-controlling interest shares goodwill, shares a portion of the goodwill. Because if the NCI has been computed using the proportionate share, meaning the 1,760 is also the one here, then the NCI doesn't share in the goodwill at all. So the goodwill will just be 810. This is in a separate scenario if we didn't use fair value to account for the goodwill at initial acquisition. So just to remind you, you can measure non-controlling interest either at fair value or at proportionate share at the time of acquisition only. However, all the subsequent years, the measurement of the subsequent changes for NCI are only using proportionate share. You cannot use fair value anymore in the NCI in the subsequent period. It's only at the time of acquisition. So it is important to note that all of this discussion here, it translates to the debits and credits, because the um, the thing that I wanted to discuss really is the journal entries, right? But it's important to not step over or gloss over the fact of the purchase price allocation, because this is where your journal entries will be coming from, as what you will see later. So let's now go into the journal entries. There are two methods that I would like to discuss with you. The first method is mainly applicable for theoretical purposes. I would say it's not very much used in practice, which you will see later. Why? It can be used for your ACCA exams because it has the more theoretical background of how IFRS 3 discusses consolidation or business combination. So the first thing to do for here is to lay out the Alpha Corporation, which is the parent company. This is for method one, because the method one assumes that the Alpha parent company exists on its own, and then they acquire new company, and then the new company in full is consolidated or combined to the books of Alpha company. So we start only with the Alpha company books. So from here, you know that there's a fair value of previously held interest. Before we do any business combination, the first thing that you have to do is to fair value the previously held interest, because that as what you have discussed before, it becomes a part of the consideration that you have transferred. So before we start anything, this 2.4 million should be 2850. What how do we do that? We do a journal entry of debit investment in beta 450, credit income from investments 450. So it is a separate it is a separate account that we use for the share in the net income, because this is not anymore equity accounting. We are just required to do a fair valuation of the previously held interest. So again, how to compute that? It is 9.5 million times 30%. So and then the difference, we book it. See? So we still have 650 in total of the net income. So we're still correct. So now this is the balances of the parent company before the business combination, you know. So the next thing to account for now is the business combination, wherein we will be using the PPA that we have computed. And also the balance sheet and the income statement of the balance sheet of the acquiree is going to be used in relation to the PPA. So what is the journal entry that we have to post? So there's only one journal entry you have to post for the business combination. That's why for me, it's quite simple, you know. So the idea of a business combination journal entry is a compound journal entry, recognizing all of the fair value of the assets and liabilities that you have acquired from the acquiree. So it is this one. So in this case, you have to take side by side the acquiree, the beta company's balance sheet. Look for the identifiable assets and liabilities. That's what we have posted here. Look for the other adjustments in fair value. That's why here we have the 600 and the intangible assets of 1.2. So the total of all of this above portion of the journal entry is the 8.8 million, because this is the net debit that we are recognizing in the book. So this debit minus this liabilities, it's the 8.8 million. So this is the net assets that we are recognizing, we are taking in from the acquiree. And then there is a net credit, because these are the values that went out of the business and including the non-controlling interest. And this is the portion of the consideration. You see, we have credited cash 5 million, credited the 2850 investment in beta. So now this will become zero. They're perfectly eliminated. And the NCI we measure at 1.9 million, just like here. So the total of these three is the total of these three are the total consideration that you have transferred for the business combination. And you will see after you do that, there is a net debit that's missing. So you know the journal entry should be balancing debits and credits. So we have a net debit of goodwill that is remaining. That's why, you know, it's very important to first establish your purchase price allocation, because from the purchase price allocation, it's where your journal entry for the business combination will be coming from. And that's it actually. After you do that, you do the consolidation and then you're finished for the first year. So so that's what the reason why I'm saying that this is normally theoretically, because it shows here the debits and credits of the assets and liabilities, which is very easy to see, you know. However, it becomes more complicated, this process, if it's the second year of the subsequent year ends of the acquisition, because then you have to track the last balances of the cash that you have consolidated, etc. So it becomes more muddy. But here you will see that you already have the consolidated balances. So from the business combination entry, this is where you recognize the books of the acquiree or Beta Limited. Here, you will see that the cash is a negative 250 because we obtained 2.5 million of cash from Beta. From the acquisition, we say, okay, we will have your cash 2.5 million, but we also paid 5 million of cash. We also paid 5 million of cash, to acquire the shares, the shares of um, Beta Limited. And here you see that in the business combination, there is no impact on the P&L at all, because the business combination doesn't impact P&L unless you have the the fair value of the assets and liabilities higher than the total consideration. So in this case, this becomes negative. It's not goodwill anymore. It becomes a gain on bargain purchase. And a gain on bargain purchase is a net credit here that you have to recognize in your P&L directly. So in a business combination that involves goodwill, and there are no other like weird IFRS topics that you have, IFRS applications like share-based payments, etc. Everything normally is a transaction in the balance sheet. You see, it's that easy. You really just have to put in the foundation of the PPA, and then you're good. So that's method one. So method two, what I would like to show you is how we do it in practice. Because the best way to really consolidate is to lay out all of the companies you're consolidating in different columns in Microsoft Excel or in what worksheet you are using, and then doing the adjustments on them. Because on the previous example, we only have the parent, and then in the business combination entry, you are putting in the details of the subsidiary. In here, you will see that the business combination can be affected even when you're already putting side by side all of the companies that you're consolidating. And I like this method better, to be honest. Okay, so we start with the same adjustments. There's nothing different from the first thing we did. So again, in order to do this properly, you have to align your previously held interest to the fair value that you used for the PPA. So here it's already 2,850, so it's the same. So again, the 2,850 is computed 9.5 million times the 30% previously held interest that you have. So the next part really is to put in side by side Beta's books. So this for me is the best way because I'm seeing Alpha and Beta Corp in one worksheet, you know. And in that case, I would like to simplify it this way. So here I just removed the first two columns so that I have more space for the adjustments. So here you see that, okay, these are the two companies that I want to consolidate. Now I want to post the purchase price allocation. So the purchase price allocation or the business combination journal entry that I would like to post is similar in effect to the ones that I already posted, because before, just to go back here, we posted here all of the assets and liabilities of the company, of the acquiree, and then credit the consideration, and then debit the remaining difference as goodwill. Here, in the example that we will, in the method 2 that we will discuss, since we already have laid out all the assets and liabilities of the company, what else should we eliminate? And the answer are the share capital and then the retained earnings of the subsidiary. These two. So you will see here, this is the business combination journal entry that you should post. You see that it is much, much simpler. So we only debit share capital and retained earnings, 7 million, which is the same as this, you see, the same as the current balance sheet in the computation. You debit the PPE net, the 600K, and then the unrecognized intangible asset, customer intangibles of 1.2 million. So all of this debit here still adds up to 8.8 million. In the previous example, this 4 4 million and 3 million here, share capital and retained earnings are broken down into the different assets and liabilities of the acquiring. But here we have simplified it. It has the same impact actually, because here we already have, if you add all of this, we already have the impact of the cash. So if you add the cash again, you will double count it. But here, if you do it this way, you just know that the share capital and retained earnings of Beta Limited shouldn't go into the consolidation at all. Right? That's why you have to eliminate them. So all of the other adjustments remain the same. Actually, it is even much clearer here because in the business combination, you see here that we credited cash instead of the 250, because in the previous example, it's positive, it's negative 2.5 million, which is the impact of this and this. But here we say that, okay, we paid cash of 5 million. We recognize the new PPA. We recognize the investment in Beta. We recognize goodwill, from the journal entry, customer intangibles from the additional fair value adjustments. We remove the share capital and retained earnings of Beta Limited because the consolidated financial statements follow the entity concept, and the reporting entity is Alpha. So only the share capital of Alpha should be present, and also the retained earnings of Beta at the time of acquisition should disappear. So it should be zero. So again, there's no impact on the P&L because the Beta P&L has been close to the retained earnings prior to the business combination. So now, this is the consolidated financial statements. It is exactly the same as the one we have done before. So you see that the total assets is 31,650. Here, the total assets is 31,650. So you will arrive at the same balances, but in method 2, it's more intuitive for me because here you're adding the two entities and then you're doing a business combination journal entry which removes the equity of Beta Limited, considers the goodwill, all the other considerations, and then you have the NCI here. You credit it. You credit the NCI here to balance everything, and this is it. So those are the two methods that I would like to share with you on how to account for a business combination with goodwill, with step acquisition, and with non-controlling interest at fair value. So first thing really is to do the purchase price allocation. If you do the PPA properly, you can do the journal entry. That I can assure you. So what happens next in terms of the first year end? What happens during the first year end after the acquisition date? So this is what we're going to discuss next. So the following are the balance sheets and income statements of the parent and acquiring as of December 31. Sorry about that. The first year end after the acquisition date. This is December 31. So Alpha Corp and Beta Limited. You will notice that the P&L of Beta is much longer now. Instead of previously, it's just operating expenses of the parent. Since December 31 of the current year, Beta already should include P&L from the date of acquisition to the first year end. So now, what happens during that time? And you will also notice that the investment in Beta Limited, so I should remove the 30% here because it's already at 80%. So we have 7,850. The 7,850 is the amount of if you go back here, the 7,850 is the 5 million plus the 2,850 that you have paid. Because this entry here, actually, the purchase of the investment will already be recorded in the books of Alpha Company in advance. And also the fair valuation, you also have to record it in advance. So now at the year end, we already have the 7.7850 million. So I think that's the only peculiar thing to observe on here. So I will not be discussing like two methods for year one year-end consolidations. I will be discussing mainly the method wherein they are both laid out in a worksheet. So in this case, what you can do is you can lay out the two year-end journal entries. And then the first thing really to do is to post the business combination journal entry we have posted before with no changes, except for the fact that the acquisition is already at 7,850. So we have added the previously held interest and then the cash consideration, because here we eliminated here. All the others should not change. Um, the goodwill should remain at 950, because the goodwill doesn't change because it's based on the acquisition date fair values of assets and liabilities of the acquiree. It is not based on the current value of the balance sheet. It's based on the value of the balance sheet at the time of acquisition, which is April 1. So all of this actually should stay the same. And that is very important to know if you're a consolidation accountant, because oftentimes it will change if the worksheet that you're working for is linked improperly. So you have to ensure that the goodwill that you have accounted for at the beginning PPA is still the same. Of course, there are exceptions, as always, because under IFRS you are allowed to change the value or to revisit the fair values of the PPA, the values on the PPA for up to 1 year from the date of acquisition. But we will not be discussing how to do that for now. So just to assume that it should always be 950. So the PPA adjustments that you have, the business combination adjustments that you have, should always be the same. So now, the only thing that I wanted to clarify with you for a year, 1 year, and console is actually the amortization of the fair value adjustments. So the remember when were reading the problem, there was an increase in fair value of the PPE for 600,000, and there's also a customer intangible of 1.2 million. So any additional fair value adjustment that you did for a business combination should be revisited every year. Because, for example, the PPE, you should depreciate that fair value adjustment based on the remaining life of the PPE from the date of acquisition, because that amount is outside of the balance sheet of Beta Limited. It's actually a parent level adjustment on the business combination, but it became part of the fair value that you acquired. So that 600,000 should be depreciated, should actually be depleted little by little, based on the life of the PPE, so that after the life of the PPE, and after which at the books of Beta it becomes fully depreciated, that 600k will also be fully depreciated. So it just aligns the value. And also the customer intangibles, for simplicity, we've used 5 years, but normally as an intangible asset you have to amortize it depending on how it was computed, for example, on maybe on the value of the customers, etc. But now we have amortized it on a straight line basis. So we have a 90k amortization of the PPE, which is the 600,000. So the annual amortization is 5 years. So you have to remember it's April, May, June, July, August, September, October, November, December. So it's 9 months. So 9 months of the 920 is 90. So it means that we have to add additional depreciation expense in the books of Beta Limited because of this fair value adjustment. And also the customer intangibles, I didn't put it here, but it's also the same. 1.2 million divided by 5 times 9 divided by 12 months. So it means that for the first 9 months of the existence of the business combination, we have to amortize the customer intangibles by 180,000. So the total of that is 270k. So it impacts the P&L. So basically that's the only impact in the P&L that you should have. That's the only impact in the P&L that you should have, basically, in the business combination. After the business combination, if you don't have any other specific IFRS in the business combination, the only thing that you have to follow really is the amortization of the fair value adjustments. If you don't have this, it's even much simpler. You just have to roll forward the previous PPA adjustment that you did. So next is the computation of NCI share in net income. So the computation of the NCI share in net income is very specific to this case because we have a non-controlling interest, which means that we don't own 100% of the subsidiary. So in this case, you have to compute all of the P&L of the acquiree, including the fair value adjustment impact, and allocate 20% of that to the NCI because the P&L that it is contributing, so for example here, it is contributing 1 million minus the 200 additional 270K of amortizations here. So it's contributing 730,000 into the consolidated financial statements. However, this 970,000 is not fully owned by the parent because we only own 80% of Beta Limited. So now we have to allocate 20% of that 730K into the non-controlling interest. That's why here you see there is why you see that there is a negative, to reduce the amount of this 1 million plus 270K minus 146, we put them into the NCI because effectively the NCI owns this 20% of net income. We should give them a share of the net income of Beta. So that's why here you see, this is the perfect, this is a more complete presentation of the net income, wherein the net income total of 420 is split between the non-controlling interest and then the owners of the parent. So you see that the owners of the parent actually has a higher share of losses because most of the losses are actually coming from the Alpha Corporation, from the parent company. So basically, you really have to remember that the NCI share is computed based on the underlying investment that you have. You don't multiply 20% to the parent company because the parent company's net income fully owns to the owners of the parent. Now, for subsequent year ends, I did not prepare a very specific discussion, but just to give you some idea, this is still on the December 31 year X, but it's still the same. You have to remember that now Beta Limited will have a full year of P&L, January 1 to December 31, year Y, following this example. So both of the parent and the subsidiary now have full year financial statements. Remember, right? And now you just have to continue the business combination journal entries that was posted previously. Nothing should change there. And then the amortization, you just have to remember that instead of 9 months, it's just full year. So nothing much special, but you really have to just follow the amortization of the fair value adjustments. Good thing to note in all of these discussions that we have is the review of the equity items. So you see here that the equity, the retained earnings, the share capital of 12,000 fully is coming from the parent company. The retained earnings at the first year end is also coming from the parent company because all of the retained earnings, all of the equity items of Beta Limited went into the as a consideration, as a fair value of it is the fair value of the net assets that was received by the company, by the parent company. So you have to cancel them out. And that's it. Hopefully you got something out of this video, and I hope that I will be able to post more cases or consolidation cases because there are a lot more things that we can discuss on business combination. For example, if there's a gain on bargain purchase, what if the NCI is recorded at proportionate share, and what if there's a contingent liability involved, etc. So see you in the next iterations of this practical discussions. Bye.